Hello everybody, this is Coach D with TackleTrading.com, here to give you an introduction and overview to the stock report. We've been doing this for a little while now, and hopefully you're enjoying the stock report. It certainly is fun for me to do, and I enjoy putting in the time and effort, and we want to make sure you're getting the most out of this. The stock report this week I got out, and I'm going to go ahead and you can find that there. We can click on this here and walk you through how to use it and use the information and make sure you understand it with clarity. So I've been kind of tweaking a little bit as we go and discovering it, and it'll probably evolve as we go, but I want to walk you through. The top is just kind of a static piece of information, kind of explains the stock report and really what we have here. Now the first piece of information that's really valuable here is this 20-year seasonal average. And if you look at this, what this is it's the seasonality tool. We use 20 years of history on the S&P index, and it starts in January down here, and it goes clear through December, and it takes all 20 years and basically averages those out and shows us what we can anticipate seasonally. Now, it is basically information and statistics. It doesn't predict the future, but it certainly can help us understand the market's cycle. And one of the things we can do is we can look every year at the beginning of the year, we can watch for what's called the January barometer. And the January barometer is real simple. You basically look at the market in January and you see where it opened, and then you look at where it closed. And then you see if it closed higher, that's a good sign. That tells us that 80% of the time the market will do well that year, and if it closes below, it's 80% accurate. That could be the year that the market doesn't do so hot. Now, if you take that that's well over 100 years worth of data, and if you go back and look at it, it's really kind of been going on since not quite 100 years, around since 1923 or so, and it is gauged and deemed to be very effective. Without that barometer, the 88% effectiveness of it, you're looking at about 66% probability of the market doing well on average, having a bullish year versus not having a bullish year without the added insight of the January barometer. And it's, as far as 40, it goes down to 44% accurate. So I can put those things up there, and I'll probably try to include that in future edition of the stock report, so you have a good idea of that. So that's where you start. So then next thing we look at is there's a general cycle to the market, and each sector is a little bit different, but you will typically see the market run through cycles of trending and not trending. So we will see where the market starts out a little sideways, and then we get really good performance from about March through May. We get really nice trends. And then the old stock market saying of in May, sell and go away, that tends to be true. And you'll typically see a dip in May, June down, July gets strong. We see a nice drop in August, and then September and October, the months that the markets have always had those significant crashes. Not always, but some of the major market crashes have occurred in September, especially in the last 15, 20 years that we're measuring here. If you go back and look at the crash of 2000 and then 2007 and 8, those are heavily weighted in this. And the cycle we see here is August tends to do okay, gives it back up. The market will do okay through mid-September, and then mid-September through mid-October, boom, it drops. Now that again is heavily influenced by those significant crashes that force that data down, but it's seasonal, and if we see the market recover and we're going to get some strength in here, we look for that fourth quarter run. And these will be, certainly influenced by overall market outlook and perspectives. We're going to have to keep an eye on things like monetary policy and consumer confidence and things of that nature. But that's a pretty clean cycle. So really what I would look to do is early in the year, we'd probably be looking to do things like covered calls and credit spreads. This is when we'd be looking for the big trending stocks, trying to get those big gains. Summer months would be financially savvy for us to do covered calls and credit spreads and things that we would want to do. Make sure you're holding dividend paying stocks, so you're getting paid if you're doing stocks. And then we'd look to hit home runs again in the fourth quarter. So that's a general cycle for you. This is powerful information. So now let me go ahead and clean that up, and we'll go back out here and kind of look at what's coming next. Then I've got it broken down. I was able to find 15 years worth of data, and this is information I collected earlier this year and kind of put together in a newsletter. But it's very powerful, and what it does is it breaks down those 9 core ETFs for the S&P, the basic materials, the energy, the financials, industrials, the technology, consumer staples, utilities, healthcare, and consumer cyclicals, as well as the S&P. And it shows their overall average performance by month: January, February, March, April, May. So you can look it up and cross-reference how they perform that month and see which ones are doing best. And so if you wanted to go see who does best in September, well, that comes down to utilities. And you could see that that's kind of your leader there. If you look at September as a rough month in general, October can be a month that actually does okay. November and December strength, you can get them there. So it's comprehensive in that regard. And then I just gave you a quick list to give you the best and worst ranked sectors by month. So best performer, worst performer, top two, worst two. So for your bullish strategies, you'd want to focus on your top two. So right now, I'm recording this in September, and September 20th to be 21st to be precise. And what we'd be looking at is right now, I would be looking at who does well through here, September, October, who does poorly, and try to get a good feel for that strength. And so we'd kind of focus on that in there, and really try to focus on strength in the utility sector and in the technical sector. And then we'd say, you know what, watch out for utilities in October because they might get hit. So you kind of look at short-term stuff in there. And then we got, basic materials weak. That'd be a great place to go short. And you can see that September, technology gives it up, but then it does really, really good, recovering and heading into the fourth quarter. So you can see that those are some cycles and things that you can take advantage of. And just making sure you understand the seasonality. Now, you can look up the seasonality inside of Thinkorswim using their seasonality tool for any stock or sector. And this is data that I pulled from other places and other resources. But the general idea is, again, incredibly powerful. So then down here, I've got those broken down individually. So it's kind of showing you each sector by month. And this is static information. This doesn't change. This is in the stock report every week. But you can come in, and if you've got stocks in basic materials, you can come and see, well, worst month, September, and you can see January. And they're ranked in worst month to best month. And again, worst month to best month. Worst month to best month. And so if you were trading a financial stock, or you were trading something in the industrials, and you wanted to know when they were the best, well, you would certainly not expect good performance in January, June, September, or February. You'd expect excellent performance in April, March, December, November, and October. So these would be places I'd keep an eye on. And again, we're looking for who's performing, and you can go by sector. Then down here, I've got the charts of these sectors. Now, this is a big piece of information and data here, and if you can use this is good stuff right here, guys. This is really, really powerful stuff. I went and created all 9 of those sectors on a layout, 20 years worth of data, and a historical calculation of averages from January through December. And you can look at, they for the most part follow that big market cycle, but if you wanted to go look at that and correlate what energy stocks do, and you say, well, here we are in September and October, you can see, they get beat up pretty rough on average. That's 20 years worth of data. Now the XLF right here has got this green line. It's the only one that's currently overlapping its historical data. That's what the green line is the historical data. The rest of it is, I was able to isolate the data without having to see the historical data because the current prices are way higher than they have been in the past. So we don't have to see all that extra data in there. But what you'll see is a general cycle. So if I wanted to see, who's the rock stars in the fourth quarter, well, check it out. Would you be surprised to see consumer staples and consumer cyclicals just rocking like docking here in the fourth quarter, and that the healthcare does incredibly well in the fourth quarter, and technology does well in the fourth quarter, and utilities do recover really, really well, and we see even basic materials will make a hit. You can see general cycles where you can see technology, or we can see healthcare tends to be better for things like covered calls in the earlier part of the year through the summer and through early months, but watch for those trends. So you can use this data and information to help you understand seasonality, the strength of each big core sector, and look at it and correlate it time of year. And we'll work on getting some bigger charts in there for you. But these are pretty decent charts, just to give you an idea. And again, you can do these types of things but it's a real great quick reference guide here. So now, let me go ahead and we'll back into the rest of the information here and go look at what we have here for the, we got that same sector setup right here, but this is current chart. So this is the current guidance for the market. This is our broad market analysis, and we've got the basic materials, and we've got the different sectors right in here, so we can click on these, and we've got chart patterns, and I've kind of blown them up so you can see them in here, and so you can come in here and we can look at it, and what we're after is well, what's the market doing right now? So at the time we're putting this together, the overall general pattern I'm seeing for the market is pretty consistent. We're seeing general bearishness. We see markets have been hit. We're seeing bear flags. We're seeing the markets get hit, consolidations. We're seeing, everything getting hit, consolidations, and, even like, things like utilities, big drop, retracements, kiss goodbye type setups. For the most part, rising wedges. So we look at each sector and try to figure out where strength and weaknesses are and which sectors are kind of poised for drops. And this is kind of my overall read for the market right now, knowing that seasonally, this is a time of year where mid-September through mid-October is when those crashes occur. Mid-September through mid-October is generally bearish. A lot of that has to do with the fact that this is the financial, the fiscal year for for the big financial firms and the big, institutions ends, and they have to do that stuff this year in the third quarter. So that's how come some of these cycles exist the way they do. Now, we can go back here and again follow through. You'll have the main market sectors, the spiders, the Dow, the commodities, etc., etc. Then this is the current market's analysis on a weekly time frame. So I've drawn some trend lines, and you can see where we can see intermediate to major trends violated, primary trends still intact, key support zones. Just a good look at the market in general. These will be updated each week. This will be information that's pertinent to the market right now. This is the S&P, a little bit closer look on a daily chart, drawing some key support resistance zones, some significant price levels, and looking at where the market's pattern is. And then blow it up a little closer so you can see some closer technicals. You'll notice in here it's giving you like names of the patterns, general seasonality for that time of the year. Here we can see some trend zones, key support zones, and then I blow it up even closer to give us, we can see the shooting star and things like that. Here's the weekly time frame for that same setup. Again, here it says daily, referring to the one up here, and then weekly, this is labeled there. And then closer look at the the signal candle in that, talking a little bit about the volume. So a good technical overview, you can expect those every week. And then I do the gridiron, and this is good, awesome, powerful information. And the way that I've broken this down here for you is it is going to include, I'm using the gridiron on the football field to help us really understand strength of the market and our general bias. And with the way the market kind of came up into that consolidation pattern in anticipation of the FOMC meeting last week, we were all relatively neutral. And then as the Fed's announcement and monetary policy came out, I've shifted these towards more bearish or more bullish, depending on which ones are showing some strength. And these are broken down. Again, you can see over here on the left, where it's got the S&P, the spider, the dollar, UUP, the ETF for the dollar, the commodity ETF, best overall commodities, basic materials, the same core sectors, energy, financials, industrials, technology, those same core 9 sectors that we've been talking about. And then I give you a little rating over here, overall, temperature gauge from bearish to bullish. And you can kind of quickly reference which ones are which. So right now I'm looking at the UUP dollar probably rallying, spider probably cautiously bearish, commodities, basic materials, all of these, energy, financials, industrials, and technology towards the cautiously bearish side. And then a little bit stronger to neutral, staples and cyclicals would be the ones I'd probably expect to do better result, have better performance. Utilities and healthcare, those are some of your stronger performers heading into the fourth quarter, and they don't get hit as hard for this time of year. So that's kind of how that works. Now, last but not least, the stock picks. And all that other information we put in there is for you to help you come to this point where you find stocks. Now, this week's picks, I didn't have to change too many of them because last week the market just didn't move much. So I actually kept some of them the same. And at the top here, I've got the spider, the diamonds, the Qs, the Russell, the dollar ETF, the commodity ETF, precious metals, gold, oil, volatility index, and the S&P, and I'm trying to focus on a seasonality bias. And these are broken down into this is a gauge over here. The way that this works here is you'll see this is going to show us a gauge from, this is kind of like the football field, but on a vertical. And then another reference guide for us, and I'll show you right now. The S&P, the diamonds, the NASDAQ, and the Russell, they're all kind of neutral to bearish. I've covered multiple on that because it could be quite bearish all the way to very bearish, but right now I'm kind of giving us a cautiously bearish to neutral bias on that. Some of the others, like the dollar, I'm cautiously bullish on. The commodities I'm a little bit more bearish on. Gold and silver, a little bit more neutral. I don't think that it's the best. I don't think they found their bottom yet, but they're definitely going to do kind of well, kind of contingent on what the dollar does. I think the dollar may be heading up. Precious metals maybe get beaten up a bit. Oil is incredibly bearish this time of year. So I probably should be a little bit more bearish on that, but kind of contingent on what the market's doing. We have to keep an eye on the dollar. Volatility index, if the market's bearish, VIX pops, and then overall seasonality. This is the seasonality saying, hey, this time of year it dips. Just a quick review of each of those 9 sectors down here. So these are, again, we're a little bit of redundancy, but it's also to help you do a quick reference guide when you're looking at your trades. Now, last but not least, these are the current picks. Now, these will be changing every week, of course. This week, I actually kept some of them the same. And just from last week, because they were decent picks, and the market's performance overall just didn't really change much. And so here we've got kind of how I've laid these out for the stock report. Is I've got it laid out so you can see some of the information. And I do my best to find stocks that fit different price ranges. So, I don't always succeed in that because sometimes it's harder to find them in the ranges I like. But I put them in there so that as we're trading stock, and of course you can trade the options on this, but I'm just focusing on clean stock, straight long and short stock. And so here we've got bullish picks and, over $100. Between 30 to 150 to 100 in that ballpark, and then less than 30. And then I've got the ticker symbol. Here we've got Home Depot, Visa, eBay. I tell you what sector they correlate to. Try to do a good job correlating that for you. Give you the ATR so you can help gauge very quickly, distances of stop losses. Give you the potential average yield, a real rough estimate on how much a typical swing is and how long it takes. That would be $8 over 10 days, $10 over 10 days, $1.50 over 8 days. I give you a trigger price, stop loss, which if you wanted to use trailing stops, you could use the ATR and gauge that and kind of give these ballparks to help you adjust a trailing stop, which I certainly would encourage you to do if you like trailing stops. And then a swing target, not a shorter term target, but a swing target. The calculation between the trigger, the stop, and the target gives us a real rough ballpark estimated risk and reward. And we can, seasonally neutral, I give you the neutral, I give you the seasonality on those. There is also down here, neutral picks. These are ideal for things like covered calls, where you can own the stock, look for ones that pay dividends like Coke, and you can look for the stocks to be neutral, good for things like covered calls. You could do them for credit spreads, condors if you wanted to as well. But in this one, I give you, ticker symbol, sector, ATR, pay range, so you get an idea of volatility, whether it pays a dividend or not, known support, known resistance. And then I look at the historic implied volatility and just overall neutral bias. Then last but not least, the bearish picks. And here this week we've got Macy's, SanDisk, and CTL. And again, put it into the sector. Macy's, and I got a mistake in there, got to go fix that. ATR and pay range, same thing. Trigger, stop, target. You can use trailing stops as well, estimated risk and reward, and seasonal bias. Very quick recap of overall market conditions for you in there, and hopefully you'll find this information very, 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 very powerful. I look forward to your feedback. If you have any questions or if things are not clear for you, certainly let me know. I wanted to make this easy for you to understand and as helpful as possible, and I wanted to see if you guys could interpret that. If there's anything you don't understand, let me know. If there's things you'd like to see added or changed, or give me some ideas of what I can do to bring you a better product, what we can do to make sure that Tackle Trading is giving you what you need to succeed, because that's why we're here. It's all about your success. So get out there and keep on rocking.